not only is Tim all those things, you know, and of course a graduate of the class of '89, but he's on our GSB Trust, which looks after about 12% of the GSB endowment. So we're really pleased to have him engaged with the school as he is. So Tim, you were at the last panel, and maybe half the people here heard that. So you might give us, just for those who weren't at the panel, in a nutshell, you know, what's going on in the world of private equity, particularly in this recent credit environment, and how has that perhaps caused you at Madison Dearborn to change your strategy, if at all?
Well, I think as we discussed at the last panel, the debt markets right now are, for the most part, closed down. So we have to find places to put our capital where it's principally equity investing only. And the things that I mentioned before really fell into two categories. One is those companies that we know that come to us in part because at Madison Dearborn, one of our strategies is to specialize in certain industry sectors. So within healthcare, I have relationships of public and or private companies that had been looking at a particular acquisition combination and actually think this environment may facilitate that particular opportunity occurring. But the debt markets have contracted not only for private equity, but for our companies as well. They're just what they originally presumed they could get in the way of leverage by accessing either the high yield market or their line of credit or the like has either gotten more expensive or just isn't there and as plentiful as it once was. So we're being invited to look at opportunities on the strategic side where we're providing the equity capital that would go senior to the common equity in a public company and or coming in as new equity in a private company, and then combined with debt that's raised instead of a 6 or 7 or 8 times leverage, would be raised at levels of 4 to 5 times. And that combination, where you have to get now comfortable with the synergies of those two companies and the like, becomes the opportunity. The other situation I mentioned that we're seeing in certain of our areas, one is, for example, in the financial services sector, where we have a specialty practice. There's an awful lot going on right there. A lot of what's needed is basically equity capital for either tier 1 equity elements, things of that nature. There's obviously the concerns of whether you're going to catch a falling knife or whether you've reached bottom on those things. Financial services, as an example, is not an area of expertise that I have, but we talk about it at our Monday staff meetings. Everything that we do as a firm is discussed at the broad Monday staff meeting. And those are situations that we're looking at as well, what we would call good opportunities in troubled situations, just in terms of the financial markets having shut down on these particular companies that were doing good things before, but there's a liquidity crisis going on, and can we solve those? So private equity, I think, historically has always been opportunistic in what it looks at, and I don't think that's going to change in this particular environment. We're just going to go migrate to the areas that we think we can get that capital to work and get the returns that we promised our limiteds, including Stanford here, where we do, they're an investor in our Fund 5. They've been an investor all the way from Fund 1, and we were out there visiting the SMC folks earlier today, or yesterday, I guess that was.
So it seems everybody's been focused on credit markets and the impact of liquidity right now, and it's a long time ago that the biggest news in private equity was mega funds. They seemed like they got bigger and bigger, and people going private, or private companies going public, people taking their firms public at some pretty exciting multiples and instant wealth creation. So in the context of all that, I mean, you think that's a prudent thing to do? Is that something Madison Dearborn would think about? How do you evaluate all that, these mega funds and going public?
Well, depending on who you speak with, they sometimes put us in the mega fund category. We're out right now doing a fundraise. We just finished investing Fund 5. It's a $6.5 billion fund, and we're in the market right now for a $10 billion fund.
We think mega.
We think the capital, what it does allow us to do at that range, we're not, some of our competitors are significant in size, upwards of $15 to $20 billion. And obviously what we think it allows us to do is play in a broad range of opportunities, making investments as small as $150 million and then being able to commit up to $1 billion in unique opportunities. So we like that particular size. We've participated historically along a full range, and we wanted to have that ability to do so in the market, even in this particular market. And then when you couple that with the debt market issues that are arising now, having an ability to write a bigger equity check becomes obviously another important consideration. So we understand we're one of the ones that have gotten bigger. There's, as you know, the critics out there would have questioned whether it takes you out of what you do well. We don't believe for us it does because, again, we've historically been investing in large opportunities, mid-market opportunities, and we'll continue to do that. A distribution that we just made on a sale that was done, a company by the name of Intelsat, that was our first billion-dollar gain that we had. That was based on an original investment of $125 million in our Fund 6, a $6.5 billion fund. So it was on the low end of the kind of investments that we look for. Obviously, the team that did that particular investment believed that there were some unique opportunities there that would facilitate a greater return than what our norms typically are, and they were fortunate enough to be right on that particular thing. The going public is an interesting question, and I don't profess to have any great answers to it. What you're seeing for a number of the funds is I'll broadly state there's really two things going on. Some have done the secondary sale, where there's been some legacy recapitalization that's gone on that's been unique to those particular companies. I think on a broader realm, there's been firms that have been looking for a permanent capital base. And with what's going on in the LP world, that is investors like Stanford, I think you heard it at our panel before, there is the asset allocation model does go to play here. And what you're having really are two things going on. The assets themselves have declined because the equity markets have contracted. And then all of us have been putting money out, at least in 2005 to 2007, at a faster pace than what the limited partners expected. So they became over-allocated in the asset class, and then their overall portfolio is smaller. And that means that they're making some choices in terms of who they're going to. And what you're seeing in part is the private equity world seeking out a stable equity base, if you will, in the permanent capital. Now, that makes good business sense, but I think the challenge is, and something that we have not done ourselves, when you're bringing in the new partners, the folks that we recruit at places like Stanford, there is this question of, whereas before when you joined, the pie that we were dividing up, the partnership, was a 100% pie. Now you're selling off a piece of that pie to either the public or whomever that is, and it creates partnership issues. Our view is that we don't necessarily see the advantages of that permanent capital right now. We've got a strong and enduring group of investors, and our belief is that we'll be able to, time and again, go access those folks. So our view is to not go access the public markets as a way to get that permanent capital base in place. Others have made a different decision, and again, there's an understanding of that, but I think each firm has to make their own choices and how they want to go. I think what you're seeing in the private equity world is somewhat similar to what happened in the investment banking world in the 70s into the 80s, where you saw a number of private partnerships that over time went public and became more institutional-like. And there is some of that going on with our industry as well. So you have a little bit of that trend at play here. We're making one choice. It isn't necessarily the right choice for others, but we think it's the right choice for us. We want to keep that partnership feel. We've been operating at one office. Others have expanded into a number of offices worldwide. We actually do invest globally out of the one office. It's something that Elizabeth, who's joining us this fall, and I worked on a deal that I think we're going to chat about, a German company. So we were making the trek over to Germany weekly for the better part of 2 months. It wasn't an easy transaction to get done. The people we were competing against were European-based funds. But our view is, for our culture and for what we're trying to do, at least for now, we'll stay in that one office. If we get more deal flow, which we've seen some of that occurring as we've done some of these global investments, then we'll look to establish an office in those forward countries. But that isn't necessarily the right strategy for everyone. It's one that's worked for Madison
right for you.
so far.
You mentioned, maybe you misspoke, you said you were here recruiting partners. I think our students would like that. What is the sort of realistic career path for people as they leave an MBA program? private equity firm?
I think none of us are that unusual. The term of partner and/or managing director is one that typically will take. I think the time duration to that is somewhere in the 7 to 9 year time frame. But when I first joined Madison Dearborn, what was then First Chicago Venture Capital in the late 80s.
There's a name from the past.
There is a name from the past. No longer. But at that time, your sharing in of the general partner, the GP, profits and the like, was something that you had to, quote, earn your way to through your time and service, if you will. And I think what we've done as a firm, and others I think do it as well, is our belief is getting people tied in early. So we share. We have our approach has been from an equity vantage to be a more flat organization, to share what we call the partnership interest with all of the people all the way through the organization. That's a different philosophy from others as well. And in that sense, one would argue one is a partner from literally coming out of the business school. The managing director title really takes on a different connotation in that environment, and it is when you get to run your own practice, if you will, when you get to be heading up a particular area where you're bringing the deal and you're the sponsor, the key sponsor to it. We all work in teams. They're typically 4-person teams, and the path, I think, would be that you'll join as a vice president, a director, and a managing director, serve in different roles on that team, and eventually you'll be heading up a practice at one point. MDP, when I joined the firm, had 4 specialty practices. We're now at 7, and we're always looking, and what that's been really the career path is for the young folks coming in to work within the different groups, migrate around, learn the business, and then if they particularly find a sector that they think is great investment opportunity, they make that argument to the broader group of folks, and if there's enough, what we believe, investment opportunity in that field, we'll go into it. Power utilities, new area for us, financial services, 2 examples of areas that we've gone into.
So you mentioned in passing a couple of, doing deals in Europe, but out of one office.
Yep.
Could you talk about either one of those? The Sorona deal, which was one of the world's leading manufacturers of dental equipment and treatment centers and imaging systems. Another deal, the Financial Times said you outgunned the European firms to get this deal, which was the business that had formerly been in the German drugs group, Merck, and it was a laboratory equipment distribution business that you were able to do. Could you talk a little bit about those deals, doing them from Chicago? How did you outgun these people? And
I don't know if I'd call it outgunning. I mean, at the end of the day, as Tom said earlier, you end up owning an asset where you paid a little bit more than the folks to your right and left. So you got to feel pretty comfortable about that. And I think what we try and do is bring a unique perspective to it, which is, some might say that's fool's gold. We think our track record would suggest that at least when we go after something, that unique perspective is something that's played itself out over time. Our specialties that we, in our different industry groups, we think give us a view. And it's not necessarily a view that others share. And again, it's not that they're wrong and we're right. We hope we're right on it, but it's what gives us, what we try and do is with a view on a particular opportunity. That's where we believe spending the time and going overseas if it needs be to get the investment makes sense. So in the Sorona Dental situation, we had spent a great deal of time understanding and knowing people in the dental space. We actually had looked at Sorona Dental. The 2 years prior, it was bought from a private European private equity sponsor, sold to another one called EQT. And at the time that we looked at it and took a pass, its U.S. strategy was still emerging. It wasn't a significant part. So it was primarily a European-based business. One key product that they had actually taken off, and it was really taking off here in the States. We had relationships here in the States that, in our view, validated the opportunity. Elizabeth spent a lot of time talking with folks both in Europe and here in the States on that particular product and the legs that it had. And one of their key customers Patterson Dental. The dental business is one of those odd businesses that the sales force is actually through distribution channels. There is no direct sales force that most of the manufacturers have. We knew the people at Patterson Dental pretty well through the years of looking in the business, and through conversations we had with those folks, came to a very firm view that that one particular product, and they basically manufacture everything that you'll see in the dental suite, but that one particular product was really going to give it the growth elements that, in our view, validated why we would pay the dollar more than the next person. So that was one part of our thesis. And the other is that in spending time in the industry, we knew a number of acquisition opportunities that this particular German-based business could make in the States. The reason that the private equity firm in Europe was selling this business is because most of those opportunities were publicly listed companies, and they weren't company with the Sarbox rules of the United States, and taking a German-based business and, in effect, merging it with a U.S. listed company and converting German GAAP to U.S. GAAP and converting German management to understanding Sarbox and the like. And quite honestly, in hindsight now, 2.5 years later, there was a lot of basis for that particular belief, because there's a lot to all that. But we knew a number of the companies they were looking at. We had spent some time with them. And the other part of ours, and this is something that we felt would give us some real upside, was if we could facilitate. Management had actually teed up a couple of these conversations. We were comfortable with it. The private equity firm in Europe was not. And we were competing primarily against the private equity arms of some U.S.-based businesses and then the European funds. So we thought we had a unique view on the U.S. market. We felt we had a unique view on the acquisition opportunities. And we felt, again, versus some of the competition, that our view of what Sarbox was about, being a NASDAQ-listed company and the like, we were more comfortable in working with the management team to get them established here. That was the investment thesis. And that's the reason that we spent the energy and time to make the trek across the pond. It's not an easy thing. You're literally leaving on a Monday. You're landing there at the beginning of their day, Tuesday, and you go hard at it all week, and you get back in time to just start to adjust your time clock, talk to your partners on Monday, and get back on the plane. So it'll wear on you, and we did that for, what, a few months, I think. I at one point said to Elizabeth, if I ever do this again, shake me and tell me not to, because it's tough. But the good news is everything played itself out. The product that we thought had legs, in fact, did. The one acquisition that they were most interested in, we helped facilitate. We ended up merging into a publicly listed company and we did the conversion. It took us 9 months to go through the proxy process and the like. We added value in those ways. We've established a public board, and the company right now, 2.5 years later, we're in at 3.5 times our money, and we think there's more life to that particular investment. So I think we had unique perspective on what we were doing relative to others. We could have been wrong, and then the competition would have been right. In this particular case, and again, we've got to get liquidity on this. We're in at the 3.5. It doesn't mean we'll get out at it, but our investment is in money good, and so far the original thesis that we had has played itself out to be true. But that's what this is about. I mean, the comment was made that the private equity world tends to be conservative, and that is in part true. But at the end of the day, we are risk takers. I mean, you're basically putting your name and your firm's name at risk on investments. It seems, as long as I've been in the business, every bet you're making is a bigger bet than the last bet you made. And you really have to have a level of conviction that you're smart enough, you've asked enough questions, and you're willing to take that risk on. It doesn't always work the way you think it will. Most of the investments we've involved in have gone left and right rather than straight up. They've ultimately turned out well for us just within the healthcare and Madison Dearborn at large. But that's what our business is about. It's asking good, smart questions and then ultimately getting some conviction and then making the bet.
So speaking of good questions, let me ask you a totally random question that popped into my mind. What matters most to you and why?
Is that a real question? What matters most to me and why?
Was that on your application when you at the time?
That it's a vague bell, and I think we've seen that whenever I help in assisting some of our young folks in applying to Stanford. But usually on that one, I tell them to speak from the heart and get out of my office and don't ask for answers. It's tough questions. You want an answer to it?
Yeah, sure.
We've now entered the realm of touchy-feely for the private equity guy.
Well, you know.
By the way, I didn't take that class. We were just talking about it. I'm an ex-military guy. I felt that.
Oh, that's right. I forgot.
Yeah.
Navy.
Didn't want to go there. Don't touch, don't feel.
Yeah. So we have a lot of students here, obviously, and they're thinking about their futures and their careers. And as you think back about your time at the GSB here, Tim, and you could do it over again, would you do anything differently? Does anything come to mind about what you wish you'd maybe done more of or less of, or any thoughts you might share with our first-year students who still have another year and a half to go?
Yeah. It was a long time ago, boy. It's amazing how quick it goes and how quick you move away from it. When I came here, as I mentioned, I was an ex-military person, went to Naval Academy undergraduate, so I basically had an engineering background and wanted to go into this thing called financial investing. And had done some on my own with my Navy buddies who, because the things we went into failed, became ex-Navy buddies. And from that, decided I needed to go get educated at a spot that could actually teach me the right way of doing things. So when I came here, I was pretty focused on any and all financial things. And I saw Professor Parker, saw Professor Van Horn, and Irv Grossbeck, and all those great professors. And Myron Scholes, I remember we had a tax class from the great Myron Scholes. That was about 5 of us in his office trying to drink from the fire hose of that burning bush. I don't know if I would recommend that. It's pretty intense, and I know he's gone emeritus. But I was very focused on really just getting a deep understanding of finance, because that's what I had a passion for. That's what I wanted to do. I think in hindsight, what I said then was, coming from the military, I had had a number of leadership classes. And what's that marketing thing? What do I need that for? And all the rest. And in hindsight, even with what I did, we were talking before about touchy-feely, which I put in the category of that's another leadership class kind of thing. I didn't go that way. So I came out with a very narrow education relative to what Stanford really offers. And what I said earlier, the panel before this, that I really do believe is at least in the business I'm in now, and even not in private equity, but I think in most of the companies, you will be astounded at the breadth of what you're asked to do on a regular basis in terms of what you have to bring to the table every day. 5 years ago, I was mostly investing. Our firm was mostly investing in the healthcare area on domestic-based healthcare service businesses. And now I've got 2 businesses, Serona and VRW, which came out of Merck, that are global. And we're trying to open up Asia-China in one, and we're trying to open up Australia in the other. And our European companies, if you don't speak 3 languages, there's a certain level of shame in that most of the Europeans speak multiple languages, things of that nature. And the questions and the way they think about things and the cultural differences and all the like are enormous. And I think I had mentioned there, advice is if you can diversify your experience base somehow, either in the summer, between, whatever it may be, it's only to your advantage. And while you're going here, take as many different classes as you can, because you just don't know what you're going to tap into. You just don't know when you're going to need that one particular skill. That dialoguing with the CEO on the comp committee, giving the evaluation to that person who's a peer, but because I'm the chairman of the comp committee, and this is the CEO of the company, that's my job, that's my role. Well, that's a little bit of what touchy-feely is about, which I didn't take. Yeah. So I need to come running back and go get the Cliff Note version of it or something. But those are conversations that you don't think about when you're going through as a student that become, I think, part of what you need to bring to the table. You need to be able to give good, sound, critical advice and evaluation to senior-level executives in this particular case, but do it in the right way. And the fact of the matter is you've got incredible knowledge on this campus, great professors, and you should really just take as many and learn as much as you can, and I guess save the notes because you might find yourself flipping back to them even 18, 19 years later.
Good advice. Well, Tim, thanks so much for your time, and thanks for coming out and being part of this wonderful conference and all you do for Stanford and for the GSB. Thank you.
Sure thing. Appreciate it. Thank you.